Hi, this is Dr. C. Kandaswamy from Department of Become Bank Management. Now I am going to discuss about some of the topics in bank management. Then the first topic is what is bank? Usually the bank represents getting the deposit from the public and allow the loan to the public. This is known as a bank. In a definition, a bank is a regulated financial institution authorized to accept the deposits from the public, offers secure shortages of for money, and provides loans acting as a financial intermediary. Banks facilitate payments, enabling savings and fuel economic activity by lending money to individuals and business. Then now we are going to discuss about what is banking management. Bank management is a process of overseeing a bank's operation, resources and strategies to ensure the profitability, stability and regulatory compliance by the managing assets, liabilities, capital and the risk, essentially balancing lending, borrowing and services to meet the financial goals while protecting depositors' funds. Now we are going to discuss about the structure of banks in India. What is the banking structure in India? The topmost person or the authority is known as RBI in India. The RBI is also called as Reserve Bank of India. Under the Reserve Bank of India, there is four categories. One is a commercial bank, cooperative bank, development bank and payment bank. In the commercial bank, there is a two segregation. One is public sector bank and the private sector bank. In public sector bank, some of the examples, that is one is SBI, nationalized banks. In private sector, there are classified into two categories. One is Indian private sector banks and in the foreign private sector bank. In cooperative bank, there is a two category. One is a short-term credit cooperative and the long-term credit. In short-term credit, agriculture and urban banks comes under the cooperative bank. In the hands of development banks, there are three categories. One is the export and import bank, agriculture bank and industrial bank. EXIM, Export and Industrial Bank, Export and Import Bank of India, NABARD and the Industrial Bank, IFCI, ICICI, IDBI, SFC, SIDBI, SIDCO, SIDCO, all these comes under the development banks. Finally, the fourth category is the payment banks. Next, we summarized to form the categories are the types of banks in India. One is central bank, that is RBI bank, then commercial bank, cooperative bank, regional rural bank, development banks, foreign bank, payment and small finance bank. Functions of modern commercial bank. Then functions of modern commercial bank. Modern commercial banks perform a wider range of functions to meet the growing financial needs of individuals, business and the economy. These functions can be classified into number one, primary function. Under the primary function, the topmost activity is acceptance of deposit. What are the deposits? Like saving deposit, current deposit, fixed term deposit, recurring deposit. The next one, granting of loans and advances. Granting of loans and advances, this also comes under the primary function. First one is cash credit, then overdraft, loans, discounting of bills. The second one is secondary function. In secondary function, there are two categories. So one is agency function and the general utility functions. The first agency function we are going to discuss, that first one is banks act as an agent of customers and provide services. Collection of checks, bills, dividends and interest. Payment of insurance premium, taxes and utility bills. Purchase and sale of securities. Acting as a trustee, executor and attorney. The general utility functions under the secondary functions of banks. One is safe custody of valuables, that is the locker facility and all comes under this category. Then issue of demand drafts and traveler check, lockers facility, foreign exchange services, ATM, debit and credit card services. The third one is credit creation. Credit creation, to create the credit. One of the unique function of a commercial bank is a credit creation. What is unique function? The most important function of the commercial banks is credit creation. One of the unique function of the commercial banks is a credit creation. By lending a part of the deposits received, banks create the additional purchasing powers in the economy. The fourth is modern banking services. With the technological advancement, banks now provide internet and mobile banking, electronic fund transfer, that is NEFT, RTGS, IMPS like that, then digital wallets and UPI services, merchant banking and investment services. The fifth area, social and developmental functions. Modern banks also support the economic to develop by providing priority sector lending, promoting financial inclusion, supporting MSME and agriculture, implementing government welfare schemes. Now we are going to discuss about the non-performing asset. What is non-performing asset? Any asset need to perform properly to its owner. What is non-performing asset? The non-performing asset comes from the customer or the credit and advances by the bank. According to the Reserve Bank of India, a loan classified as an NPA if the interest and or principal payments remaining overdue for the period exceeding 90 days. This is a very important one. That is the payment which is exceeding 90 days. Okay? That is, a loan is classified as a NPA if the interest and or principal payments remain overdue for a period of exceeding 90 days. Up to the 90 days, it comes under the category of defaulter. After the 90 days, that is from the 91st day, we called as a non-performing asset. Once a loan becomes an NPA, it stops generating income for the bank. It stops generating income of the bank. NPAs are typically categorized into three main categories, that is three main types based on the duration of non-payment and likelihood of a recovery. One is substandard asset. What is substandard asset? The asset that having remaining as a NPA for the period less than or equal to 12 months. That is when it crosses 90 days. That is when we cross 3 months, a defaulter once cross the 3 months, he comes under the NPA. That is non-performing asset. In the category of non-performing asset, up to the, that is from the 91 day to 364th day. That means from the 3rd month's first day to the 12 months. It comes under the substandard asset. Then doubtful asset. What is doubtful asset? Doubtful asset. Assets that have remained in a substandard category for the period of 12 months. After the 12 months, that comes under the doubtful asset. Then loss asset. What is loss asset? Assets where the loss has been identified by the banks or auditor, but the amount has not been written off wholly. Such assets are considered uncollectible. Any amount comes uncollectible, or the things which we are unable to get from the loan borrower. Okay, that comes under the loss assets. Okay, causes of NPA. Then what is the reason? How the NPAs are creating? How the NPAs are growing? That is a process of NPA. Reason: poor credit risk assessment. The primary thing is a poor credit risk assessment. Nowadays, so many strategies are followed by the bank with the guidance of RBI. Credit risk assessment is in a right way. Poor credit assessment, fraudulent activities, economic downtrodden, and unforeseen circumstances. These are the main causes of NPS. Early warning signal. What is early warning signal? We are giving the signal to the defaulters to move or not to the category under the category of NPA, non-performing asset. Then number one is payment delay. Missed or late payments indicate the financial strains. Borrower behavior, that is changes of financial status like a business deadline. Market trends, the economic downtrodden can affect the borrower's repayment ability, credit history. These are all the early warning signals. Strategies are adopted by the banks to reduce the non-performing assets. This is a very important one. The thing is, what is a non-performing asset? Causes of non-performing asset. Then how the RBI guided to the other banks to recover the funds from the non-performing asset. Okay, non-performing asset weaken bank profitability and liquidity. To reduce the NPA, bank adopt the preventive, corrective, and recovery strategies. There are three strategies followed by the RBI guidance. One is the preventive strategy. What is preventive strategy? Under the preventive strategy, proper credit appraisal. The credit appraisal should be in a proper manner. Then know your customer, KYC. Nowadays, without the KYC, no single account can open, or the KYC is the thing which is continuously verifying some extent. That is know your customer, identification and verification of the borrower credential. Credit rating and credit assessment, evaluating the credit risk before the sanctioning of loans, early warning signals, monitoring delays and the payments and operations of issues, diversification of credit, avoiding the concentration in the single sector or the borrower. All these points come under the preventive strategy. Then second one is corrective strategies. Corrective strategies, loan restructuring, rescheduling, repayment terms of viable borrowers, one-time settlement, that is OTM, settlement of dues at the negotiated amounts, additional finance with the monitoring, supporting a revival of stressed but viable unit. The third one is recovery strategies, legal action, recovery through the DRT, SARFAESI and the Revenue Recovery Act, sale of NPS to AMC, asset management companies, a transfer of bad loans to the asset management company, compromise settlements, mutual agreement for recovery. These are all the recovery strategy. Okay, latest measures taken by the RBI to control the non-performing asset. How to control the non-performing asset? That is number one, asset quality review, insolvency and bankruptcy court, prompt corrective action, strengthened provisioning norms, bad bank concept, revised prudential framework, improved credit monitoring system. These are all the things. Next, we are going to discuss about the investment management. Priorities, that is priorities of bank funds allocation. The priorities of bank fund allocation, essential consideration for effective bank funds allocation, including the government securities, portfolio construction, and the profitability management. Investing in government securities, consideration of maturity and yield. Then what is maturity and what is yield? We need to classify. What is our maturity? The maturity refers to the date when the principal amount of the bond is repaid. It plays a crucial role in investment decision. Yield. Yield represents the rate of return on investor receives on the bond investment. It's often expressed as an annual percentage. Balancing quality and diversification in portfolio construction. That things we need to classify: quality and diversification. Quality. Investing in high quality assets. Investing in high quality asset with a strong credit rating and sound financial fundamentals reduce the risk. Then diversification. Spreading investment across different assets, classes and sectors, migrating the impact of any single asset's performance. Profitability management, optimizing investment return. One is 10% and 15%. 10% maximize returns. Employs effective investment strategy to achieve optimal return by managing risk. Minimizing expenses, controlling the operation costs and the fees to enhance the overall profitability. Then profit planning and projected financial performance. Development comprehensive financial plans that project future profitability considering investment returns, operating expenses and market trends. Then risk of e-banking. A new era in the financial services. The banking industry is evolving rapidly with a traditional brick and mortar institution facing the fierce competition from the online banking provider. This presentation explores the key features, benefits and the challenges of e-banking, highlighting its impact on the modern financial landscape. Features of e-banking: accessibility, convenience, security and cost effectiveness. Then internet procurement, online bidding, automated approval, electronic catalogs, all this internet procurement. E-banking transaction, how the funds are transferred in a nowadays e-banking transaction, fund transfer, bill payments, loan application, investment management, all these comes under the e-banking transaction. Electronic delivery channels, online banking, mobile banking, telephone banking, ATM, all these comes under the electronic delivery banking. Transaction, reduced paper, faster processing, enhanced securities, all these functions are the special character of truncated check. Completed centralized solution CCS, consolidated data, streamlining operations, improved efficiency, all these complete centralized solution CCS. Advanced and the constraints of e-banking, one is convenience and other one is security. Without convenience and security, we can't follow anything. The convenience and the security is the most important of e-banking advantages. Thank you.